items. This webinar is being recorded and it will be posted on our website in the next couple of days. There are also notes that accompany this presentation on our website, and let me show you where those are. So if we go over to stockrover.com, we'll see webinar-outline.html, and the top line here, when to sell, is today's webinar, and you can get it in Word or PDF format. And also, there should be a PDF handout. That PDF should also be available as the handout directly from the GoToWebinar software we're using for this webinar. Please note we've put everyone on mute to limit the background noise during the presentation, and we encourage questions. So feel free to type questions into your question box at any time. We'll answer all the questions at the end of the webinar. Finally, and probably most importantly, note that none of what I'm going to show you constitutes a recommendation to sell a particular stock. All the stocks that are used in this presentation are just for example purposes only. They are not explicit recommendations to sell. When you make a decision to sell a stock or to buy a stock, you should always do your own original research, and you should always make your own final decisions. And with that, I'd like to begin. So I'm going to switch over to, I'm going to work off the presentation notes initially. This is the PDF. So when to sell. The first part of what makes selling difficult is what I call the emotional problem. First, a little quote in italics here. The field of behavioral finance has demonstrated the pain we derive from market losses impacts us twice as much as the pleasure we feel from market gains. So in other words, losing hurts more than winning feels good. And that does create a conundrum for selling, particularly if you have positions that are underwater. Personally, I find deciding when to sell to be the hardest thing to do as an investor. Why is that? Again, it's much more of an emotional decision. You've already made the decision to commit to the stock, and you form some sort of bond with the stock. You're familiar with its behaviors, you know about the company and what they do, and you have familiarity. So selling's like, it's a bit like departing with a loyal, or perhaps a disloyal friend. When you're selling, basically you're really in two states. Your stock's either making money or losing money. If your stock's making money, it's treated you well, you might feel a bit disloyal in selling it. And more importantly, if you feel that it's done well in the past, you feel, why can't it continue to do well in the future? I mean, if it's done well, it must have momentum on its side, which is Newton's first law of motion. And it's also a well-known and real effect in financial markets. You also face two other issues when you consider selling a winner. One is you're going to generate a guaranteed tax bill. Now, if you have losers to offset that, that will be useful. It might make it so there is no tax, but it is noticed by the government, and they do want to get paid, basically. And also you have the problem, if you want to stay invested in the market, of finding a better replacement, which means working your part. The other situation is your stock is losing money. So if your stock's treated you poorly, you may secretly feel it's really only a question of time before the market recognizes its virtue, and you should wait it out. And that's a completely rational way of looking at it, particularly if you're a value investor. But on the other hand, if things have really changed for the worse, and you can clearly see that, or perhaps when you did your original research, you missed a key investment fact, such as maybe you bought a company that has a lot of debt and didn't realize the importance of how the rising rate environment was going to be such a problem for companies with weak balance sheets. In any case, you might know that something has changed, and in your heart it's time to go. When you do that, you know you're going to be feeling a loss because selling is going to be an acknowledgement of a mistake, perhaps a big mistake, and it's also the abandonment of hope, because once you sell, you've taken the loss. It can make you feel stupid. Sometimes, and I've been known to have these thoughts, I just think, why didn't I just set fire to my money? And if you hold the stock, hope beats stupidity on any emotional scale. So those are all kind of reasons why you might hesitate to sell. And then there's the other big fear of hesitating to sell, which is you might have had a stock that you've suffered with for a long time, and then you do finally sell it, and then it rallies right afterwards. And believe me, there's no worse feeling in investing. First of all, you lose money, and then you're left behind while everybody else kind of has a better time with the stock. Makes you feel even stupider. It's happened to me, and it does not feel good. So the emotional component of ownership makes selling a stock much tougher decision than buying. And the side example I just want to mention that I think everybody can relate to is that when people sell their houses, they generally think that their house is worth quite a bit more than the realtors do. And realtors spend part of their job is trying to get clients down to realistic selling prices. And the reason is people tend to overestimate the market value of their home. Unfortunately, the same can hold true for stock ownership. So how do we counteract that? So the practical solution, and it's really quite simple, but it does require research. You've got to start with, and this is what I do, I start with the following question, and I just try to answer it honestly. If I didn't own the stock, would I buy it today at this price? And if the answer is no, I wouldn't buy it, you should probably think about selling it. There are exceptions to this. If you have a huge gain in a stock and it's going to generate a big tax bill, and the stock might not be your favorite pick or might not be great in your estimation, but it's okay, you may want to hang in there. And the other thing to be aware is if you really don't know the answer to this question, you've done your research and you're just not really sure, you can always hedge your beliefs by selling just part of your position. That's always an option. It doesn't have to be all or none. So in answering that question, what kind of things do you want to look at, factors to consider? And I think I've listed seven items in this bulleted list, and we're going to walk through all of them. But by far, the most important is the business fundamentals. You really got to pay attention to the fundamentals of the business and relate that to what you think the value of the company is in the stock price. Other things you might want to look at is fundamentals might be great, but the valuation might be inappropriate in your view. That might be a reason to sell. The overall health of the market. If the market's doing poorly like it is now, it's very difficult to make money in individual stocks. You want to look at forgetting all the fundamentals, you just want to look at the price performance of your stock. How's it performed? If it's performed badly, even though you like the company, unless you know something that's going to change that, that could be a consideration for selling. You want to look at other technicals, some of the chart stuff. Some people consider it to be voodoo, but it can be helpful in determining whether you want to continue to own a stock or not. And then finally, there might be management issues you want to consider, and I'll mention a couple for a few example stocks a bit later in the presentation. And if your stock is in play with a hedge fund, which means it can be a push-pull that results in violent moves, and you don't have any special information, you really want to consider whether that's an arena you want to play in. So those are some of the factors to look at, and as I said, we're going to spend the most time on business fundamentals. So let me take a breath of air here and switch over to the product. And let's start with business fundamentals. Within that category, there's a number of subcategories to look at. I'm going to start with the most basic one first. Is there a change in the business outlook for the worse? And the first thing I would look for is declining sales. If your company's revenue in the future if your company's sales are declining and the future looks like there's going to be more of the same, you've really got to question as to whether you want to own the stock, because it's going to be very difficult for the stock to gain profitability and earnings growth with when the primary fuel, which is sales, is evaporating. So I'm going to use two examples of well-known companies for that. The first is IBM. And if we look at IBM, I've put up I've created a sales growth view that just has 4 metrics in it, which is the 10-year sales average, annual average growth, the 5-year, the 3-year, and the 1-year. And it's very interesting when you look at IBM. The overall 10-year growth has been just a tad negative, but as you get into closer periods, which means the more recent years, you see the negative sales growth has accelerated. That's not good. And if you look at their sales history, and what I've done here is I've opened up the Insight panel, I've selected IBM, I've opened up the Insight panel, selected the Detail tab, and the Sales and EPS subsection. We can see that if we look at their sales, that their sales peaked in 2011 at about $106 billion. and since then have been declining and are expected to accelerate their decline. So it's going to be tough for a company like that to do well in the future. And if you look at the stock price over the last 2 years, you can see the carnage that has occurred because of the decreasing sales. It's basically dropped from 200 to under 125. Similarly, Qualcomm used to be growth stories 10 years ago to 5 years ago. It's growing pretty well. The growth has been very good, but recently the growth has really tailed off. 3-year averages down 5%, and last year they actually went negative. And again, if you look at their sales history, you see they peaked in 2014 at 26 billion, and then you can see the sales starting to decrease and carnage the stock as it was up in the 80s, and over this 2-year period of decelerating sales, you've seen increasing, I'd say, an acceleration of price declines to the point where it's well under 50. So clearly, the value trap. So you definitely want to look at that. Other times, sales can be very good in a company, but there might be future pressures that the market is concerned about. And then I think a very good example for that is a company called Gilead, which is, I'm sure everybody's heard of, a giant biotech. Let's take a look at that. So I'm going to change the view here. Actually, you can see the sales growth. I'll leave that because I really want to focus on the 3-month chart for this company. And I'm going to just make this disappear so we have a little more room. Here you can see that, like all of biotech, Gilead's been in a decline. But you notice a particularly sharp decline the week of January 26th. So as an investor, this clearly indicates that the market is feeling way less positive about the future prospects. What happened? Well, they pulled the daily double of bad news, and let me show you each of those things. The first thing was on January 27th, the Massachusetts Attorney General basically opened a new front against Gilead about legal action about the high price of their drug, of their lead drugs for hepatitis, so which is their primary source of revenue. So that's headline news. Doesn't mean anything's going to come of it, but investors were scared. But then they pulled the daily double, the weekly double, and that the next day on the 28th, Merck's competitive drug got approved. So fear of competitive pressure. So both those things. Made for a very bad week for the stock. Now, you see a little pop here, and that's because they just released earnings, which was superb. So if you own the stocks as an investor, you have to decide whether that headline news is going to translate into something that you think is really going to be negative for their future outlook, or whether it's just not a big deal and this too shall pass, in which case you would hang in there. So that's a decision you have to make. But certainly the market's signaling that it thinks the future business outlook of Gilead is less impressive than they used to think it was. Another way a stock can get kind of hurt with business fundamentals is when they themselves talk about kind of what I'd say is a disappointing outlook. And I'm going to use a company called the Alliance Data Systems, ADS, as an example for this. And I want to go to a 3-month chart, which we have up. And this is a stock that has been trending down with the market, but this was their earnings announced. This was their conference call date, earnings announcement date, and you can see a plummet from 250 to 200, and then further plummet. So what happens? Well, this is a growth stock, and if you can see the 10-year, the growth of the revenue, for example, has been quite strong in the last number of years, and this is owned by growth investors, and it's actually not an expensive growth stock. They expected roughly $19 of earnings going forward, and they basically guided down to $17 of earnings going forward next year, and that's a basic 5-6% decrease, but the stock went down 20%. Growth investors fled. In this environment, they shot first and asked questions later. The problem the stock has now, and if you own it, you have to think about it, is that the growth investors have fled, but it's probably, so it's no longer considered a desirable growth stock, but it's not cheap enough yet to be a value stock, so it might not have a good constituency. And as a result, the supply-demand dynamics for the stock might be poor. So if you own this stock, you might want to consider selling it for that reason alone. Even if you think long-term that the market was unfair to the stock, you might actually get a better entry point going forward. And if there's another thing you've got to be concerned about, this is Alliance Data was a case where they, announced that things weren't quite as great as they had hoped. But a stock can basically say everything's great, but the drumbeat of negative headlines can be a real problem for the stock. And for that, I want to use Apple as my example, a stock everybody knows well. This stock has done very well, and then kind of peaked this summer. iPhone sales were fantastic. Everything was looking great. Valuation wasn't bad. And then things started to go south in the July period. And what happened was really two things started making their way in the headlines. One is the slowing of China started to become a much bigger component of headlines, and then the concern that the iPhone was not doing well, kind of leaks from suppliers that future orders weren't great. And that, even though nothing's really changed as far as announced quarters, investors are feeling that the future may see, less earnings growth or potentially even earnings decreases in the future, and it's pricing accordingly. And the stock has really been taking it on the chin because of that. So bottom line is, if your stock has a drumbeat of negative headline news, it might actually translate to legitimate fears, and that's one of the things as an investor you have to try to figure out whether the headline news is in fact, a serious concern or whether it's overblown. You can see the same thing with a couple minor stocks I wanted to show you. One is BHP, and the other is Freeport-McMoRan and FCX, and I'm going to chart them together. Let me just do that. And let's didn't get that chart, and we're going to compare and compare. Sorry, chart and parent chart. So we got these guys up. We got the I'm going to put a 6-month the S&P up, and we'll look at these stocks for the last 6 months. We're going to click on the S&P here to flatline it so we can see relative performance. Now you see these stocks kind of were doing okay for 6 months, but in the last 3 or 4 months there's been a tremendous amount of negative news out of China, particularly on the infrastructure build, which consumes commodities that these guys produce. And you can just see that that news flow, as well as the kind of declining view of their future prospects, has really made these stocks lose a tremendous amount of value in a hurry. So when your stock starts getting negative news, you want to be pretty quick to decide whether you think this is going to be an ongoing problem, is going to depress the price further, or whether it's something the company can ride out. In this case, it's been pretty tough on these companies. One last thing I want to show is energy, which everybody's quite familiar with. I'm going to show ConocoPhillips for that. Let me chart that. And I'm going to add in a benchmark of crude oil. And I want to look at this over a 2-year period. And crude oil's in brown, Conoco's in blue, and you can see that Conoco kind of follows crude oil down, and if you own a stock like this, well, you have to really decide what you think is going to happen with energy. If you feel it's really near the bottom and it's going to kind of basically eventually turn up, then that should be good news for the stock. But if you feel it's going to continue to decrease, energy prices will decrease or are going to kind of bounce along at this very low level for a long time, this is a stock that you probably would want to consider exiting. So you've really got to pay attention to the news, because the news can do a number on your stock, on your stocks, and it may be because the business outlook really is worse, or it may be an overreaction, and that's something investors have to decide. Sometimes you can have the wrong setup for the current environment, and for that I want to actually, before I do that, I want to do decreasing estimates. This is another thing that can really do a stock in. For this one, I'm going to use Polaris, and I'm going to get rid of crude oil because Polaris is a recreational company. Polaris has been a darling kind of stock for a while, but has not been lately. And we're going to look at the analysts, go to the Insight tab, and we're going to look at the analyst estimates. I'll make this a bit wider. And this is kind of an interesting, make this wider still, I think. Yeah, still wider. Okay. So analysts tend to be slow in realizing that things are not going well for businesses, but once they kind of get on board, their revisions downward can continue for a while. And this is a stock that really has frighteningly large negative revisions by the analyst community. It's talking about next year and the year after, and next year the earnings expectation went from $8 a share plus to just over $6, and the following year from $9.50 to $7.10. Those are big negative reductions. So that's the last 90 days, but actually these revisions started back in the summer, and you can see that the stock was doing just fine in the 150 range. Once the analysts started revising down, they've been continually revising down. So you might look at this stock and say, well, it's trading at 75. It's only at 10 times PE, but you have to figure that that given what's happening with the revisions, there'll probably be further revisions down, and that the PE you're thinking about might not actually be the PE the market's valuing it, and the stock definitely has the potential to go lower. So you've got to pay attention to what the analyst estimates are, because if they're going down, they tend to continue in that direction, and that puts a lot of headwind pressure on the stock. The next thing I wanted to look at is too much debt. Here I'm going to look at Ryder, which is our United Rentals, and we're going to look to the balance sheet. And we'll look at the graphs of each of these stocks. I'm going to do a one-year chart on these guys. So you can see Ryder's kind of coming along, and then it's really kind of gone on a slow decay from 90 down to 50. So what's happened? Well, interest rates, the Fed has started to talk about raising interest rates. This company carries, they only have $1.41 in cash per share, and they have $103 in debt per share. So it's a very debt-heavy company. And with a weak balance sheet in a rising interest rate environment, that's a recipe for poor stock performance. Additionally, the stuff they sell with global demand slowing can be something, that's another headwind, because so their debt costs are going up, their kind of fuel, their revenue is under pressure, and that's kind of a fairly toxic situation for the stock. And unless, again, you think something's going to change for Ryder, this isn't the greatest environment to own a stock like this. Similarly, United Rentals has the same, like $2 a share in cash and almost $100 of debt, and has suffered a similar fate, actually a worse fate, from over 100 to under 50 in a 7-month period. And I think that's a combination of demand concerns and debt concerns. And if you have a company with a weak balance sheet and a rising rate environment, you definitely want to pay attention to that. Okay. So another thing that can be interesting is your stocks could actually be doing really well, but from a financial point of view, but the market might not like them, and I think autos are no better example. So we're going to switch things around a bit. I'm going to actually minimize the chart, and I'm going to change the view to return versus the S&P 500, so we can see relative return. And I'm going to select the consumer cyclical sector, which holds a number of industries. Industries are smaller, are kind of subdivisions of sectors, and you can see all the industries that make up consumer discretionary. And these are the relative performances of the sectors of the industry versus the S&P 500. And if you look at autos, these three areas, you can see nothing but red. There was a brief period a few years ago where auto parts did okay, but these have underperformed the market forever. And you say, well, that's kind of weird. Auto sales are at their peak. They had the best year ever last year. This year looks strong. With low fuel prices, they're selling more trucks than ever, which are higher profit margin items for them. What's going on? Well, the market's figuring that this is, in fact, peak year, and the future is going to be much bleaker, and it's priced that in. And if you own stocks in these industries, you're facing tremendous headwinds because of the fact the industry is performing poorly. So you have to decide whether the market's being overly pessimistic about auto sales or not. But if you own stocks in this area, you have to realize that you're swimming against a pretty powerful headwind for your stock to make money, and it's going to be much tougher to do that. So what I want to do, let's look at a chart too. So we're going to take auto trucks and dealerships, and let's chart that. And let's compare that to, so you can just get an idea of how it's performing versus the S&P. And we're going to do that chart for 1 year, which we've got, and we're going to flatline the S&P. And you can see that with the concerns about global growth, and even with very low energy prices, which helps autos, the dealerships have been crushed. And if you have a dealership stock, it would be very tough to be making money in this environment. And that trend looks like it might continue. If you pick other autos like the manufacturers, you see that these guys actually kind of tanked even earlier and are on a similar trajectory, and auto parts as well, which is in blue, is doing a bit better, but that's starting to decline as well. So this whole area would be tough to make money in, and if you have stocks in there, you would want to consider that factor when you're thinking about selling. Another thing you've got to think about, we're going to switch back to companies, is whether your company is getting pressure from key competitors. So I'm going to clear this chart. I'm going to work with 3 well-known tech companies, Facebook, Google, and Twitter, and we're just going to graph them all. We're going to do a 1-year chart, which we've got, and we're going to flatline Facebook, which is the blue one. So this is the performance. This is the orange line is Google, and the blue line is Facebook, which has been flatlined. So you can see Google and Facebook are running about the same. Now you see there was a period back in the beginning of the year, you should say the beginning of last year, that that Twitter was outperforming these guys, and that was probably might have had something to do with some of the impending management changes that were expected, Jack Dorsey coming on board. But since then, the stock performance relative to these guys has really deteriorated. So what's going on here? Well, all 3 of these companies are fighting for ad dollars. And what's happening is it's pretty clear from the recent earnings releases that both Facebook and Google are getting more powerful. And that's putting more and more pressure on Twitter. So if you own Twitter, you can see that they're having a tougher and tougher time competing for advertising dollars. And you would have to consider that with tough competitors like that are gaining market share, that you might not want to be in an ownership position. So you've got to look at the competition story for stocks you own and make sure that your stock you feel it's as competitive as it ever was. And if it's losing any competitive mojo, you definitely want to think about lightening up or selling the stock. Other things that can happen to you are concerns about the industry that you operate in. And we're going to look at biotech for that because that's actually really interesting case. So biotech's been doing very well. If we do a 5-year chart, we can see tremendous strength, and now you can see it's really fallen off the table, particularly here, okay? So we're going to go back to a 1-year chart, and we're going to add in the S&P 500 as a benchmark, because the market itself has obviously had its weaknesses. We're going to flatline them. And you can see this outperformance at the beginning of the year of last year has turned into underperformance for the last 6 months or so. In a particularly bad time, right around this week of September 21st, September 22nd, and negative momentum carrying through that. So what happened? So again, let's go to the news. Hillary Clinton was the first of the candidates to launch a broadside against the pharmaceutical industry, and you'll notice the date of 9/22 on that. And that was really kind of the beginning of the end of momentum for biotechs. And what's happened now is a number of the politicians that are in the current election cycle have come out on the drug price issue, and it's creating tremendous headwinds for the industry. And given the election is just in the early innings, this is probably a headwind that's going to happen for a while. So if you have stocks in biotech, even though they have great they might be great companies with great prospects, you're definitely fighting an industry-wide headwind that's going to make it tougher to make money. And then there's a couple of kind of unusual cases, but if it happens to your stock, you do have to pay attention to it. One would be kind of a major lawsuit I want to show you what that can do to a stock. And for that, we're going to use Trinity just on its own. Trinity Industries is a railroad car and highway guardrail maker. They probably do other things, but those are two of their primary businesses. And this is a company, and that's very interesting. I want to show you the fundamentals of the price to earnings on this company, which is now around between 4 and 5, basically. And I think for Trinity, I want to do a 2-year chart here. So let's do that. So here you can see a company that's doing pretty well, and then it just fell off the table here, and then the negative momentum has continued. So, well, what's happened? Well, 2 things. One is transports in general and railroads have done very poorly, so they've been a victim of the. But another thing that's unique to Trinity is they were sued by the federal government, and if we look at this web page, this guy Joshua Hammond is kind of an activist, but the key thing is right here. October 2014, the federal jury decided that Trinity defrauded the U.S. government. After this, so if we go back to their chart, we can see this is where things really, this was an anticipation of a negative outcome of the trial, and then this is the negative outcome. And since then, the state of Virginia has sued them, and the legal stuff's still going on. But it puts tremendous pressure on your stock to the point where you could be screaming about the valuation just being obscenely cheap. But on the other hand, it could get cheaper. So that kind of negative news, where there's an uncertain outcome, which could be very expensive for a stock, would be something that if your stock is in a situation like that, you would want to think about not taking that kind of risk, basically. So that's kind of a number of business factors I wanted to look at, and that's kind of the biggest part of the presentation. And I now want to switch to kind of other things to look at that aren't really about the business prospects, but that you have to you should look at when you're considering whether to make the sell decision. The first thing is our old friend valuation, which is pretty critical. And I want to use for valuation, I want to use Raytheon at the beginning. And I want to use a 5-year chart for Raytheon. Raytheon's a great company. If you've owned it, you've done very well. You'd probably be in a profit situation with the stock. But if you look at its PE, for the longest time, its PE was in the 10 range, 10, 11. And then since then, the PE has been expanding, and it's continuing to expand to the point now where it's kind of at the highest point it's ever been. It's over 18. It's never been there before. And while their earnings have grown for sure, the largest part of the price appreciation has come from the PE expansion. And if you own this stock, you've got to be thinking about how much more expansion can this stock have. It's a very slow grower, and it's a steady stock, but you might be thinking in terms, I'm not saying you should sell this stock, but you might be thinking in terms of considering taking a bit off the table, thinking that it's had its run, and this might be as good as it gets for Raytheon. Now, valuation, here we're talking about growing earnings and growing PE. You can also have a PE problem because the part is actually decreasing. And I'm going to use NCR as an example for that. And I want to show you their earnings. And I'll go to the detail section here. And we'll start by just looking at their earnings. Their peak earnings were in 2012. And since then, their earnings have been decreasing. So here's a stock where actually the PE is getting higher, but the stock price is getting lower, and the reason is that the earnings are deteriorating. So you can actually back into a valuation problem just because your earnings are poor, not so much because the price is appreciated. Just kind of something to be aware of when you look at valuation. Okay, moving forward, another thing you really want to consider is the overall health of the market. So let's look at a chart of the S&P 500. So let's clear this out. I'm going to make the chart bigger. And we're just going to chart the S&P 500. And we're going to add in some technicals, which are the simple moving average for the 50-day and the 150-day. And when you look at this 5-year chart, you can see there was turbulence around 2011, but we basically have been in a bull market for a long time. The 50's been above the 150, basically. But here, this market's getting more volatile. We're getting a lower high. We're getting some big drops and getting some really scary-looking behavior. And so what you kind of realize is if you're investing in this period, you have tailwinds on everything you do. But if you're in this area, you're now starting to get some serious headwinds. So you've got to consider when you're thinking about holding or selling a stock, what the market environment is. In a more negative environment, your bias should be more stronger to selling. In a more positive environment, your bias should be stronger to holding. Now, within the S&P, there's a bunch of sectors, and they can all perform differently. And I'm going to create a chart of that. This is going to look a little messy at the beginning, but then I'll clean it up. So let me clear the chart. I'm going to graph all the sectors just by saying chart all, right-clicking here and saying chart all. And I'm going to go to a one-year chart, and these are all the different sectors. And I'm going to add in the S&P 500 as a benchmark, so we can see how the sectors are doing relative to the S&P 500. And I'm going to flatline the S&P 500 by finding it here. It keeps moving on me, and clicking on it, which will give that as the red line. And now we can see some real differences in sector performance over the last year. What immediately catches our eyes are the blue and the brown, which are respectively energy and basic materials blue, energy brown. We can also see right away this one right here. That's consumer defensive. That's doing very well in this environment. And we can also catch this green one, this bright green one, which is financial services, and that's really showing negative momentum right now. And that's probably due to the concerns with energy bankruptcies and banks holding a lot of debt in that. So you look at that environment, and you basically can say, okay, well, the market's a little iffy, but within that, the sectors that are quite strong, such as consumer defensive, and the sectors that are really weak, such as financials, that if you're thinking shorter term, you're really going to be swimming against some serious headwinds with that sector. And then you could look at this sector, like these two sectors, energy and materials, and see they've really done poorly, but you might be thinking they're bottoming. They might be. If you look at a two-year chart, it's even more pronounced how badly these guys have done. So one of the things as investors, you have to decide whether this trend here has run its course, and these guys are kind of now okay now, or whether this is just going to continue downwards, because sometimes you get a little up and then a further down. So it's very important to be aware of the sector you're investing in within the market, because that can have a dramatic impact on how well your stock performs. And even within sectors, there can be some interesting variations. So I'm going to actually show you kind of, let me go back to sectors, and I'm going to pick the consumer discretionary. And these are all the industries within the consumer discretionary, anywhere from advertising agencies to leisure to restaurants. We've already seen auto. And these are the performance of these sub-industries versus the S&P over various time frames. And if basically green is good and red is bad. So when you look at this, you immediately see the autos have been bad. So you can be in consumer discretionary, consumer cyclical, and if you're in the auto subsector, you're going to have a rough time. But on the other hand, if you're in, say, restaurants, you can see that this has outperformed the S&P in every period, and that's been a relatively strong period. So you have to pay attention to the industry you're in as well as the sector. And within that, there can be wide dispersion of industry performance within a sector. It's just another thing to pay attention to. There's also something else which could happen is rotation. You could be in a sector or an industry, and there could be rotation out of that. And you have to be aware if that's happening, because if there's rotation out, that's going to create a headwind for your stock. So let's look at, for example, healthcare as a good example for that. So if we go to healthcare, we're going to see all the industries of healthcare, and we can see kind of a mixed bag. We can see long-term health has performed very poorly, and medical devices has performed well. The one I want to focus on is diagnostic and research. If we look at this subsector, we performed the S&P in the 5-year and 3-year periods roughly the same in the 2-year period. It's outperformed in last year and in the last 3 months. But now it's starting to underperform. The underperformance is accelerating, so there might be rotation out of this sector. And if you own a stock where there's rotation out of your sector, that's going to be, again, that's going to be yet another headwind. So that's one more thing you want to look at when you're evaluating your stock. So that's kind of the health of the market side of it. One thing you've got to just look at is just how the stock is done. It's its own performance relative to the market. And one of the things I like to do, and I'm going to go back to, unfortunately, Alliance Data System for an example with this. Let me pick, where is it? Chronic underperformance. Alliance Data System, we can see the 5-year return. This is a growth stock, and if you look at the overall 5-year return, it's been great, but you can see since then it's been quite negative. So this is kind of a growth stock that had its growth period. If we chart this guy, let me clear the chart and chart this, and we'll chart for 5 years. You can see that run up, and now you can see it's kind of like had its day. Seems like the market thinks it's had its day, and it's going down. So if you have a stock with this kind of recent chronic underperformance that's getting worse, you've got to really seriously think whether you want to own this stock. You have to be thinking in terms that either the stock is so incredibly cheap that it has to be owned, or that the market's missing something and I'm right, and therefore I'm going to hold on to it. But the market's definitely telling you that all the momentum for the stock is negative, and that you would have to expect the likely path is that the underperformance is going to continue into the future for this stock. That's kind of one price technical to look at. There's also a lot of chart technicals you can look at. And we're going to look at some kind of charts to give you some indication of things you might want to look at. So I'm going to switch to the technicals watch list, which has, I think, 5 stocks on it. I'm going to start with Netflix, which is a stock everybody's very comfortable with. And I want to switch to a 2-year view here and indicate times when you want a stock that you might want to think about getting out. And to help with that, I'm going to add in the simple moving average technicals of the 50, which is in red, the 50-day moving average, and the 150-day moving average, which is in yellow. And if you look at the stock, you'll see that this is, except for recently, generally on a 2-year uptrend, the 50 riding above the 150 and the price line riding above the 50. So those are all good things. It's a momentum stock, and the momentum's been positive. But what I'd like to point out is that when it takes a giant move like this, like right here, or right here, or right here, not so much here, but here, these are times when you might want to think about lightening up. You might miss more of the upside, but in general, when you get these big moves, the stock tends to return to trend line or even go under it. So if you own a stock that's a real momentum stock and it's really kind of had a big move above trend line, you can definitely think in terms of reducing a bit of your holdings and taking some profit, because there's a pretty good chance it's going to, at some point in the future, come down to the trend line. As I say, you might miss a little of the top, but you probably miss more of the bottom. Another thing you have to pay attention to are moving average crossovers, particularly when the 50 crosses under the 150. And I want to do a 5-year chart with SPY, which is an ETF that follows the S&P 500. And you see that same similar chart, kind of noise in 2011, the market in a bullish, and the 50 riding above the 150 really the whole time. And here we get a significant cross. Now, we had a little cross here, almost a touch, but the momentum continued. But here we have a cross, and we can see a pretty big dip underneath. And even though the market's recovered, a lot of times the market will give you a second chance to get out. You can see another. This is kind of a warning sign that you might want to, when you see these crosses and the major dive underneath, the 50 diving under the 150, you might want to think, give serious thought to lightening or even selling, depending on what your point of view is. So that's something to look for, is these average crossings. You can also want a stock that's just in a continuous downtrend, and we'll use, again, Freeport-McMoRan. This is 5 years. You can see the 50 and 150 kind of run together, but it's just down, and there's no moderating of this trend. So even though the stock is trading at like $5, it could go to 3, 2, or 1. So it's just something to be aware of. This stock does not look like it has a bright future, and it looks like the future is going to be more of the same. Another thing to really look at is a double top, and I'm going to use Disney, which is a stock that I personally like a lot, but I can't argue with the charts. And I'm going to go back to a 2-year chart with this guy. And here's a classic double top. And what's worrisome is the second top is lower than the first top, and the the second bottom here is lower than the first bottom. This is a fairly bearish chart, and you're also seeing the crossover and you're seeing the rollover of the momentum. So as much as I personally like Disney, and I do actually own it, full disclosure, I have to pay attention in the short term that the market is not feeling favorable towards Disney. In my case, I'm going to hold it long term. I like the company, I like Star Wars, I like everything they're doing, but I definitely recognize that this stock is probably more likely to go lower than higher in the short term. And another stock I want to look at that I think really illustrates issues is the problem of what I call lower lows and lower highs. And Goldman Sachs, and I'm going to get rid of the technicals for this because we don't need them. Just looking at the chart can tell you the story. Goldman Sachs is a company that has really been under pressure, and you see that when the bull run ended kind of in July, a series of lower highs and lower lows. All the highs are lower, all the lows are lower, and you could draw trend lines on both of those, and that's a stock that, unless something dramatically causes it to reverse course, is in a really bearish chart. So if you own Goldman Sachs, you just want to be aware of that chart and factor it into your thinking as to whether it's a stock you want to hold. So that's kind of a brief thing on technicals. There's just two more things to go. I know this is running along, there's a lot of information here. One thing I want to point out is management issues, and I want to use, go back to Yahoo. Yahoo, this is its chart. It's a 2-year chart of Yahoo, but basically you can see that it's really been under pressure for well over a year. Why? One of the reasons, there's been a lot of controversy with its holdings of Alibaba and what they're going to do, but what's really been underlying a lot of pressure on the stock is concerns about the business, and it's been exacerbated by the continuous exodus of top management talent from the company. You know, top executive after top executive is leaving, which makes you really wonder about the leadership and wonder about the future prospects of the company. And this is a stock, when I see something like this, unless they have some sort of major takeout event where somebody buys them at an elevated price, the charts are indicating this is likely to go lower. Similarly, Twitter is another one we've looked at, and you can see that this stock has gone lower. Now, we already talked about the competitive pressures they have with Facebook and Google. In addition to that, they've just had recently a bunch of management turnover, which I think happened, I'm not exactly certain when it happened, but it's pretty recent. And you can see that when a bunch of top managers either left or were fired, it didn't do much to inspire investor confidence, and that is something that has put a lot of pressure on the stock. And this stock also suffers from the fact that the CEO actually runs 2 public companies, which is unheard of, actually. And as an investor, you've got to wonder how much energy any individual has to run 2 public companies. So I think there's real management concerns here, and I think it's reflected in the stock price. Another thing I'm going to point out, which I don't have a chart for, but I want to show you a website that I kind of like, is if your company is quite aggressive in its accounting and then they change auditors. So how do you find that? Well, I'd love to tell you it's in Stock Rover. It isn't, but there is a website that I found called Big Four Auditor Carousel WordPress.com, which has a list of companies that are changing their auditors and who fired who, basically. And if your company's on this list, you can pick kind of any period you want and see different, different companies that have kind of gotten rid of their auditors. You can basically, like, here's one where it looks like the auditor didn't want to renew with this company. You might want to think in terms of what's going on and do some serious due diligence on the reasons to consider whether you want to own the stock or not. And I think the last thing I want to mention, there's a few more things here, actually, almost not quite there. I want to mention Skechers, which is a company that's actually done pretty well, and it's a apparel company that's a very high growth company. But one of the things that gives me pause about this company is what I consider to be greedy management, and I'll show you what I mean. If I go to the summary tab and I click on insider transactions, I can look at the last 6 months, and I can see that there's been almost 1 million shares of this stock sold. There haven't been any purchases, and that the insiders have sold 23% of their holdings. That's a lot. In addition to that, institutions are bailing on this company. They've lost 20 million shares, or 16% of their institutional sponsorship. And if you look through the sales, you'll see that the Greenbergs, Jeffrey and Michael, are just selling spectacular, are getting granted spectacular amounts of options and then selling them, just generating amazing amounts of cash, 30 million, 15, 10 million. This is all in a period of this year, 9 million, 12 million. I mean, how much money is enough? You've got to look at this management and say, unless the company is doing so well to overcome this kind of expense, is this a shareholder-friendly company? Is this the kind of company I want to own? And then the last thing, before we open it up for questions, is hedge funds. If your company's in a hedge fund war, and there's two I can think of off the top of my head, one is Herbalife, which were kind of between warring hedge funds, you can get a behavior like this. And this is a 5-year chart of Herbalife, and you can see that it's been a real roller coaster. It's really been vibrating between 70 and 80 and 30 and 40. And unless you know something or have a real firm commitment towards the company, this is probably an e-ticket ride that you don't want to take because you just are going to be a passenger and you could lose a lot of capital in a very short period of time. So if you're in a company, if you own a company that is involved in kind of a hedge fund war, you definitely want to think about getting out of there. And Vertex is another, Valiant is another one that you can see this kind of been a hedge fund war over, and that had the whole fraud issue and pricing pressures, and you can see what it's done to the stock. If we go to a 2-year, it's a little more clear. So, I mean, this has been a headline kind of stock. It's got a lot of, it's supported heavily by, I think, Bill Ackman at Pershing Square as a major hedge fund owner who's just bet tons of money on it. If you believe in him, you might follow him. He's tried to support the stock, but there's been a lot of negative news from other institutional investors, and you can see it's been quite a ride. And unless you like that kind of volatility, it's a ride you might want to avoid. So that's kind of what I have for today. I just want to sum up by saying that what you want to do as an investor is, I've shown a number of factors you want to be looking at. You want to examine all those selling factors, and you want to examine them honestly and with an open mind. And then after you look at everything, you want to re-ask that critical question, which is, if I didn't own the stock, would I buy it at this price today? If the answer is anything but yes, you might want to start to rethink your ownership position. And with that, I'm going to conclude the webinar. I want to thank everybody for taking the time to join me today. I've really enjoyed giving the webinar, and we're going to open it up to questions. So thank you.
Okay, I'm going to hop on here. Hello, I'm Alex Reisman, the Communications Manager at Stock Rover. That was great. Very interesting presentation. So we have a few questions that came in, and this is a great time. If you haven't asked a question and you have one, please send it in now, because we'll get through these and then close the webinar. So I think we'll start with the top here. Can you compare competitors for gold and silver ETFs and companies?
Let me just pull, I'm sorry, I got to get the question box open so I can see it.
Yeah.
Can you compare competitors for gold and silver ETF and company? I'm not sure I really understand that question.
I think it was when you were looking at oil and you had and you also had the ETF for biotech. That you had just like, if there's, I think there's a way of basically just getting context on those.
Those guys. Okay. Yeah. Let's see what we've got. Yeah. So I think in the commodities for benchmarks we have gold and crude oil as potential. So we could graph gold, for example. I'll get rid of Vertex because we don't really need it. And you could actually compare that, for example, against the GLD ETF. And see how well they've mapped, and they've really kind of followed each other. And then you could probably look at an ETF that has miners and see how that's done. I believe up here on the commodities section, we click on commodities, there's a whole bunch of other commodities you can look at, like I believe silver is in there, and then this is also chartable. So if we, let me scroll up and chart silver. So you can add silver to the chart and see how that's doing. And there's a silver ETF, although I'm not familiar with silver because I don't trade it. I think there's companies like Silver Wheat and SLW, I think. So you can certainly look at all that stuff with Stock Rover if that's what you're interested in doing.
Mm-hmm. Okay, next question. Would, and I think this was actually answered in the presentation, but I'll still ask it. So would looking at what insiders are doing, buying or selling, have any meaning?
Yes, it does. It has a lot of meaning. What you want to look for Well, in the case of Sketches, like just they're actually on a predictable options grant and selling schedule, but the amounts are just so huge. I mean, it gives me pause as a potential shareholder. In other companies, you want to look for a change of pattern. If somebody's doing XXXX and all of a sudden they start doing Y or Z, which might be either selling less, selling more, buying more, you definitely want to pay attention. So what's really important with insider trading, insider transactions, is the change in pattern, and that's really what you want to look for.
And then what about stock buybacks? How to tell if management is manipulating the stock price via pumping up the EPS, and how to detect that?
Yeah, that's a great question. I mean, one of the things you want to do, and let's pick Gilead. I think they've been buying a lot of stock, I believe. And I want to switch to the income statement view, and I want to just have Gilead only. I think one of the things you can look at is their share counts. Now, if you expand this, you can see their share counts, Gilead's share counts over time, and you can see they've expanded, and now they're starting to contract. So you can see how much they're contracting, and from that you can kind of guess how much they're spending on buyback. So you can just look at the share count. You can also look at the income statement for Gilead, which would be in the statement category. And I'll do, let's see. Yeah, you can look at, where is it? Shares outstanding. You can see the shares outstanding, how it's changed over time. You can see that they're reducing share counts. Now, you want to look at the diluted versus basic, because the diluted is really what matters, because that includes option grants. What a lot of companies do is they buy back shares, they issue options, they try to show a net decrease in shares, but they actually spend a lot of money, kind of buying to mask some of the options grants. And you can find that by looking at the balance sheet. You should be able to find the amount of money they're spending. I'm sorry, the cash flow is what we're doing. The amount of money they're spending buying stock. So let me see if I can find it here. Financing. So you can see common stock repayment. So there you can see the repurchasing of stock. Basically, you can see how much money they're using to buy stock, and you can map that against. You can actually do the math to figure out the net change in shares and see what's going on.
Great. Okay, how would you know if a company is in a hedge fund war?
Headline news. Also, you can look at institutional ownership of a company, but you would have to, which is typically, that's a good question. I think typically, look, hedge funds own many of these companies, and that's fine. I mean, but and many of them are stable long-term investors. But when you start seeing headline news, when you start seeing, a company in the news with Carl Icahn's going after a company, or Bill Atkins pushing a company, or this, you have to start to, your ears should perk up. So I think the headlines would really be indicative. So I think what you'd want to do is, for the companies you own, is follow the news flow. And you can do that in Stock Rover just by going over to news and looking at ticker-specific news. And you definitely want to see if your company is kind of in the news at all. So you can see there's a bunch of information that you can find on your stock on the news feed. So, yes.
I accidentally skipped one. So shouldn't the decision to sell be mainly dependent on whether the stock is fairly valued as of the date of sale? That is, is the past history that much of a component of the decision?
I think that, yes, you want to make a decision based on whether the market thinks it's fairly valued. And I think you want to look at a number of factors. You might think, if you think the valuation is fairly valued and you want to hold it, but the market is telling you that it's overvalued and decreasing its price, you want to try to understand that disconnect. But at the end of the day, you should make your decision based on what you think the stock is worth, and make a decision as to whether you think the market's got it right or wrong, and then based on that, make your hold or sell decision. So it does come down to value, but you have to be aware that there are so many things that affect stock price beyond just things that are on financial statements. And what I'm really saying in this presentation is you have to pay attention to a large number of factors when you make a sell sell decision. Because ultimately, prices for stocks aren't set by things like PEs or financial performance. They're really set by the supply and the demand for the stock, which really means how much other investors want to own or not own those stocks. And so you have to pay attention to what other investors will think and why.
Great. So the next question is easy. Will the slides be available?
Well, what's available is what I made available, basically. The presentation itself, the total presentation, will be available, and there's the outline of the presentation that's available on the website. But there's no kind of, a whole set of slides or anything like that.
Yeah, it's just the notes that you can download, and there's a link to that in the control panel, and I think you can actually even download them directly from the control panel under the handouts section.
That's right.
Yeah, that's a new feature. So next question, and we do have a number of questions that did just come in. So do you have any thoughts on selling in the context of rebalancing and how to use Stock Rover for that?
Oh yeah, I have a lot of thoughts on selling rebalancing. Of course, that's not today's presentation, but what I will show you is just quickly, if we pick a portfolio, and this is just a model portfolio that has, I'm not even sure what's in it, but it has these stocks in it, these 5 stocks. You can use a tool if you're a premium user or you want to use our premium trial. If you're a basic user, you can do the premium trial to test it out. We have a rebalancing facility. And that will allow you to basically set your desired percentage for things you own, and you can also set a drift tolerance so that you can allow it to drift a certain percentage before you're told to rebalance, and then it'll give you kind of a trade plan. So if I were to set a drift tolerance, say of 5%, and I'll use the current percentage. I'll just change these percentages a bit so you can see what it looks like, and we'll just update this model, and then when we go to rebalance, we can see we'll get this nice window that has kind of the current quantity and what should be the balance quantity. And if it's red, it means that it's drifted enough from its optimum point we would consider a trade, and the trade to balance is this, and this is the impact that's going to have on your cash. So I definitely do balancing between sectors and stocks within sectors, and that's critical to investing. So certainly when you make a sell decision, you're going to want to look at your overall, portfolio situation, but be aware that if you sell a particular stock, if you want it to stay balanced, you can always buy another stock in the same industry or sector. So this was really focused on performance of individual stocks, but that's a wider context you always have to pay attention to.
Great. So the next question is, does Stock Rover look at S&P earnings estimates for 2016 and 2017? For example, most analysts feel the range is between 120 to 128 for 2016. I think those are too high and probably will be revised down.
We don't, and the reason is that there's just so much dispersion. There's so many experts that come up with so many different numbers, and they're constantly being revised. We're not really certain how that's going to be helpful in any way, so we have not incorporated it in the product. I think if there is demand, we certainly could look to try to find some sort of aggregated statistic that has kind of the consensus view of it, but we don't have it in the product.
Let's see. The next question is, rather than taking one stock through the metrics you went over, can you set the system to screen the metrics or some of them that you went over today so stocks that should be sold are identified and vice versa? In other words, ones you should buy.
Absolutely, and that's the whole screening talk. I mean, that's something you would normally do, is you would embody a lot of these concerns in a screener, and then you'd run the screener against things you own and see, you can find out what's passing, what's not passing, and you would also run it against the general population of stocks to see things that, if they're good things, the things you might want to buy, and if they're really bad things, if your predilection is to actually go short, you could consider selling, buying puts or actually even shorting the stock. So yes, you would definitely want to embody this in a screener. I did it this way just to show kind of the things you would look at, all the different factors in selling, but screening is really a whole separate topic, and we do periodic webinars on that.
Yeah, and we have a number of screening resources on the website too, so if you want to learn sort of the specifics of how to make a screener in Stock Rover, check out some of our help resources and videos, and we have a bunch on that. Can Stock Rover screen your own portfolio or any of the mentioned sell reasons?
Yeah, you can. I believe it's if you right-click on the. I'm always forgetting it. If you right-click on the to screen basically a portfolio, or you right-click on it. If you go to a screener you like, and you can right-click on it, and you can apply the screener to your portfolio. For example, I'll apply this to the dividend stocks, and it will. This particular screener, which is a long-term growth screener, will rank the stocks within the table and also show which ones pass the screen and which ones don't. And this is something that's very valuable to do to kind of a sanity check on your portfolio versus criteria you think is important that you've embodied into the screener.
Okay, so next question, where do your analyst estimates come from?
They come from all. It's the sum of all the kind of registered analysts that cover the companies, basically. So if you go, for example, to ConocoPhillips, and we go to the which is select, and we go to the analyst page, there's 21 kind of registered and known, analysts, and they come from all the big companies, basically, that do sell-side research on these companies, and that typically the same people that would be on a conference call that are asking the questions after the call.
All right, this is a little bit longer one. So I understand that in looking at the various metrics history on why the stock should have been sold, what is a good strategy to have when the stock is first purchased? That is, when it hits a certain price, I sell, or when its fundamentals first degrade against its sector or S&P, is that when I sell? So basically, what's the philosophy after you've bought something that you should have going forward?
It's a good question. It's a very good question, and the short answer is all of the above. I think target prices are tough to set because the market has a way with momentum of carrying stocks far past where you think they could go. Also, when you set a target price, companies are dynamic. You set it at a certain point in time, but companies are changing. They can be getting better and stronger, and the target price you might set it and forget about it, and it may not really be appropriate. The company might be in a much better position than it was. Google would be an example of that, a company that changed their accounting practices and brought in some financial discipline, and the stock has been soaring. So you might set a target on a price like that, and it will just blow right through it. So I think if you're setting targets, you've got to constantly be on a regular basis, I shouldn't say constantly, but on a regular basis reevaluating whether the target is still right. And if you do feel that the target is right and it does hit the target and that's your philosophy, you should sell. The other thing, when things start to degrade, my ears really perk up. I mean, I think if it's, then you got to decide if it's a one-off, kind of not important event, or this is the beginning of a stream of negative news. A good example would be like Apple with iPhones. When one supplier kind of says, well, my orders are soft, you start thinking, it's the first one, is maybe he's got other customers that are soft, maybe Apple's doing well, but, so you might not react to it, the very quick would react to it and sell right then and there, and that they would have been right in that case. But then when you start hearing 2 or 3 suppliers, you've got to start to pay attention. So I think you've just got to use your instincts on kind of when you really feel the fundamentals are changing, when the story is changing. I think one of the hardest things for investors to do is they put all the research into a company. They like the story, they like the fundamentals, they like everything about it. They've made the commitment, they want to be done with it, they want to mentally move on. But it's a dynamic thing, and if the story starts to deteriorate, you really don't want to feel like going back into it and checking it out. But honestly, you have to, and that's just part of the deal with investing. So it's really, you've got to be looking at everything.
Great. What is the policy of updating data on a stock, the timeliness of it? So how much time between its quarterly reporting and the update of that data in Stock Rover?
When we get the final gap statements, in other words, the company posts them to Edgar, we get them generally within a day. We have preliminary information, and we're looking to put that out, so we get that as soon as they announce. I don't think we have that yet, but that's something we're going to add into the product. But we want to make sure that when we give you numbers, that those numbers have been vetted, so we wait until the company publishes them officially with the SEC, and once those are published, it's generally within a day we get those numbers.
Okay, I'm going to jump to a related question, which is, what is the universe of stocks in Stock Rover?
It's the companies in the North American exchanges, so the NASDAQ, the NYSE, the Toronto, and it's about 8,000 stocks currently. We also do kind of less analysis on the ETFs and funds. We're going to be improving that in the future, but for now, the full research universe is around 8,000 stocks in North America.
Okay, great. So now a couple of questions that are actually not about selling, but this one is about mapping to a brokerage account, which is obviously our new capability. So this person is asking, if I initially map to my brokerage account, can I also map to my historical portfolio without losing either and have them both update?
If you Yes, I mean if you link to a portfolio that has historical data, it will keep the historical data and use the brokerage data going forward, basically, is the best way to say it. So you don't lose it. But you won't be able to change it. Once it's linked, the data is locked, basically. We don't allow modification of linked portfolios. We are going to allow editing of cost of the cost basis in the next release, but currently it's not editable.
And I don't know that you can link to the one portfolio to two portfolios in Stock Rover. So if you had one with historical data and one that didn't have historical data, I don't think you could link it to both of them.
That's correct.
Okay, so how does one, by doing all this, outperform a good mutual fund manager who has all this information also, is smart and does this all day long? Is it by having a more concentrated portfolio or question mark?
I know lots of mutual fund managers well, and actually a lot of mutual fund managers use Stock Rover. It's going to shock you to find out that they don't really have any additional information that you have. Probably the only difference is, in theory, they do it full time and you might have a day job, but they really don't have any informational advantage over you. It really comes down to kind of how you construct portfolios, what you value. You can easily beat a good mutual fund manager if you just have sound portfolio construction practices and sound research practices. All the information is there. Some of the things that come to mind is unless you really believe in something, you don't really want to be overweighting too much in one individual stock, because if that stock has a bad day, it's going to crush your portfolio, and it's tough to recover from that. And you basically you want to be paying attention, and you can, as in today's webinar, you can see definite signs of deterioration. There was a news item on CNBC that Bill Miller, who's one of the most famous mutual fund investors ever, who beat the market, continuously, is down 20% in January, which is more than double the market. So there's no secret elixir that anybody has. The playing field is way more level than you would think.
Great. This is just another question on brokerage linking. Does the new managed broker link automatically update the portfolios, or is it a one-time update?
It's an automatic update. It updates every night, and I believe it also updates if you ask it to, and it will update, I think, when you log in, basically, if you log into Stock Rover. But it happens every night automatically.
And final question, do you use percentage decline in a stock from the purchase price as a basis for a sell decision?
Definitely. I mean, I don't have a set formula like if this stock goes down 10%, I'm dumping it. But if a stock has had a significant percentage decline from my ownership position, it's really on the edge of being kicked out. In my earlier investing days, I would tend to hold stocks far too long that I thought would turn around that never did. And now if I buy a stock and it kind of goes south on me, I pay attention and I have a much quicker trigger finger. So yes, some people say if it goes down 10% or it goes down 20%, sell it. But you've got to be careful, because if you then redeploy your money and the next one does the same thing, before you know it, your capital will really be dissipated. But you do want to have some sort of selling discipline. And if you get a big price decline, you've got to pay attention.
Great. So that was the last question. So I'm going to sign off.
Great. Again, I want to thank everybody for attending. We had our biggest crowd ever today, so I think that might be indicative of the market, which has been a crazy kind of thing. But if you're a long-term investor, I think all will be okay in time. So with that, I want to wish everybody a great day, and again, I want to thank people for coming. We'll see you guys next time.